Hello, it's Wednesday, the 1st of April, getting a quick video in before the long weekend in the UK. If you're wondering what to make of all this news around Iran and the conflict there, don't worry, you're not alone. The market is also really sort of struggling to get a grip on exactly how to read what's going on. There has been a slightly more positive tone in markets over the last few days, actually quite a positive tone in the US yesterday, up around about 3%. On the day on Tuesday, having had a decent day on Monday as well. And if you're looking for sort of really meaty evidence in terms of the news flow as to why that might be the case, you're going to struggle. But perhaps there has been a sort of a change in tone towards slightly more positive, and perhaps that's what's underpinning markets over the last couple of days. The markets are still off, of course, around about 5% in the case of the US. Over March since the high point at the end of February. UK's off a touch more, between 6 and 7%. But overall, certainly the last few days, there has been a sort of a seemingly turn towards more positive outlook. What's sitting behind that? Well, there has been some more positivity in the news flow. There's indications from the White House that there may be some sort of resolution coming down the track. We're seeing words like off-ramp being used more widely by commentators, de-escalation, those sorts of phrases. But at the same time, there is more material heading towards the Middle East. There are more troops turning up there as well. And so, it's not a given that we'll get a sort of an immediate and sort of simple resolution to this conflict. So the jury, I suppose, in that sense, is still very much out. It is evident, of course, that a lot of damage has been done in Iran, and you are starting to see a sort of a reframing, perhaps, of the objectives of the US. Really focusing on nuclear capabilities rather than sort of guaranteeing supply of oil through the Strait of Hormuz and those sorts of factors. And perhaps that's enough just to sort of give market participants a slightly more sort of positive outlook in terms of what's going on, and crucially, whether we can sort of find a way to sort of find a positive solution to all of this in the relatively short term. On the positive side, we haven't seen a broadening into a more regional conflict. We haven't seen any sort of on-the-ground action from the US yet either. And so, there is an argument that it remains relatively contained, but that doesn't diminish the fact that as things stand, there's very little, if any, oil really sort of coming through the Strait of Hormuz, and there is likely to be some sort of pinch of supply in the relatively near term. And what's interesting about that is the focus we were talking about in the last video, where people were really sort of worried about inflation and how high that could go in the short run. That is diminishing slightly, not least because oil is sort of stabilized around about $100 a barrel. So it's not sort of outrageously expensive if it stays where it is here. But the other focus is firmly on, will it impact growth? We were seeing a lack of oil really sort of coming through, and indeed other things that generally pass through that strait. The concern is more now, rather than it being a big inflationary impact, that you have a sort of crimping of global growth. And you're seeing, as a result of that, government bond yields coming down because the inflationary pressure perhaps diminishing slightly. And of course, also sort of reflecting the fact that if growth does come under pressure, governments and central banks are going to be less inclined perhaps to be aggressive in terms of their interest rate increases. And if that's the case, then it has a number of sort of positive benefits, most notably the cost of finance and financing. If your risk-free rate is the measure of which business success and investment success is measured as the sort of first impact point, if that comes down, your cost of capital will come down as a result of that. And so you can sort of see that it just loosens up the sort of the friction that we were seeing building in the global economy. Another potential positive from that, of course, is if these yields do come down, the government debt burden in terms of servicing that debt reduces as well, particularly anything they issue now. It won't have to be at such a high yield as it would have been a couple of weeks ago. But even that yield move, it's all right in the US. It's back down to the sorts of levels. The 10-year in the US back down to the sorts of levels we saw in August last year. So it's not sort of outrageously high, but elsewhere, UK is a notable example. The 10-year remains high. You have to go back to 2008 to find a 10-year at a similar level in the UK. And there are particular features of the UK market, the sort of lack of energy independence, that reliance on importation of oil and gas in particular, that may mean that inflation remains stickier in the UK. But overall, again, the picture is one that's sort of generally seeing a de-risking and a moving away from some of the sort of catastrophizing that perhaps we saw only a few weeks ago. One concern, of course, is if growth is under pressure, it's not necessarily a particularly sort of helpful environment for stock markets. There is an indirect linkage only there. Of course, the economic cycle, the performance of economies, is distinct from the business cycle and the investment cycle, but you can understand why there would be some sort of interplay between the two. If growth is significantly coming under pressure, it sort of provides a bit of a headwind really to business performance and to their ability to create that profit to return to shareholders. And so it's not a sort of given that if growth comes off and pressure there is reduced in terms of inflation, that it's good for markets, but perhaps overall this sort of reduction in the sort of acuteness of the risk, acuteness of uncertainty, with some glimmer of hope for resolution, is enough to sort of overcome some of the concerns that the slower growth might otherwise be causing for investment managers, market participants, and the like. So there's still plenty of unknowns, really. Markets generally don't like uncertainty. So, why are they rallying? It might just be a sort of a desensitization. It might just be, regardless of news flow, which you can sort of pick positives or negatives in, people just sort of a bit fed up of selling. And also, of course, more prosaically, perhaps, markets have come off. Equity markets have cheapened up. All else being equal, if you could sort of ignore the reason why they've sold off, you can look at markets today and say, well, look, they are 5, 6, 7+% cheaper than they were a month ago. If you're positive on markets a month ago, there is an argument that you should be even more positive on them today. But of course, that excludes thinking about the potential repercussions of what is going on in the Strait of Hormuz. It is possible, of course, there is a quick resolution, but there are still lingering and meaningful concerns that you have a long-term disruption in terms of oil supply through the Strait, and a long-term disruption that could come through in terms of global growth from there. It's always tempting to distill these problems into sort of very binary outcomes, to think, well, if it's all fine, oil comes back down $80 a barrel. If it continues on, oil rushes up to sort of $200 a barrel and becomes very challenging indeed. The reality through history, in many similar sort of instances, has been actually somewhere in the middle. Don't underestimate the human and indeed the business propensity to muddle through, find some way of sort of making it all work. You only need to look back as far as this time last year and the tariff surprises to remind yourself that, while that was a shock at the time, it wasn't actually as impactful for markets. It wasn't actually as impactful for economic performance as you may well have presumed it would have been at the time. And in fact, despite it being something that looked very sort of perilous for emerging markets, for example, classically very meaningful exporters of stuff around the world, they actually had a really decent year last year despite the tariff surprise. So it's a good example of how you can have a short-term disruption. It's not necessarily going to create the outcome in terms of stock markets that you would immediately presume it would. And all of this again boils down to I think a realization that market behavior is somewhat unpredictable over the short term. Sentiment, whether it's good or bad, has a really sort of meaningful impact in terms of prices over the short term. But over the long run, fundamentals should be rewarded. And so you can make an argument on the basis that, you've had this significant disruption, growth of uncertainty over the last month. Markets have cheapened up as a result of that. But even if there's not a sort of an obvious, really sort of positive outcome in terms of the conflict, if you allow yourself to sort of believe that, muddling through is a possibility, you can sort of argue that, stock markets today, at a discount to their valuations of only a month ago, are starting to look a little bit more attractive. Again, how that plays out in the short run, it really is sort of a matter of conjecture rather than anything more than that. That's why in the Liontrust multi-asset team, we really want to focus on being disciplined, investing for the long run, investing in fundamentally attractive markets that are cheaper on average, giving you that sort of long-term upside potential, being diversified, making sure you have lots of different returns drivers in your portfolio, and finally, of course, being sort of differentiated. We are in a different world to that from 10 years ago. Challenges that we are facing today are not the same as we would have had in that sort of relatively quiet period between the financial crisis and COVID. You've got this multipolarization going on. You've got a very new geopolitical environment, new challenges to be faced. And as a result of that, we think it remains important to remain diversified, disciplined, but crucially differentiated in this different environment. That's it from me. Enjoy your long weekend, and we'll see you next time.